Joining us right now is Roger Ferguson, former Fed Vice Chair, as well as a CNBC contributor. Good morning to you. Before we get into it, just your reaction to the jobs number. Do you put this in a good category? We had Steve Leisman, who found a couple of holes in it. What's your thought?
Well, look, overall, a very good category. The unemployment rate coming down, always very helpful. You know, the job creation number after the ADP surprise yesterday, very welcomed. I'm not sure I agree with Steve on the parsing. I'm not opposed to it, but I think Rick Santelli said something very important, which is this is an economy that's driven by the service sector. That still seems healthy. So overall, this is a check plus. This is a good labor market report.
Okay, so now maybe I'll ask you the question I asked Steve. If the President, Trump, were to call up Jay Powell right now, or Jay Powell were to call up President Trump, and they were to talk about the numbers we just saw across the tape, the conversation would go how?
Good question. Let's assume a world of great rationality. I think Chair Powell would say, Mr. President, this is a good labor report. I think he'd also say something broader, which is the President himself would be better off if the Fed were widely perceived to be independent. I think the President's calling for lower rates in the face of this kind of strong economy or good economy is probably unwise. Steve Leisman said something I think Chair Powell would bring to the President's attention, which is if the Fed were to cut in the face of these kinds of numbers, the market might not accept it as a sign that they too should be lowering rates. The long end of the curve may actually show higher rates as people worry about inflation picking up.
Roger, can I just ask you, though, about that, which is, and it's actually contextual to even these jobs numbers, this bill today. There had been an argument. The conventional wisdom would be if you're going to add a lot more debt to our balance sheet in the United States and the dollar and everything else, you would think that the bond market would be unhappy about that. You would think. And yet, it has not been remarkably unhappy about that. Steve Leisman has made the point, potentially, that there's already a view in the marketplace, forget about next month or the month after, that a year from now, there will be a different person in that Jay Powell role, and that they'll be lowering interest rates. Do you think that is what accounts for what's happening here?
No, I don't. I think what's happening here is there are many cross currents that are driving the bond market. One is the ones you just talked about, which is, more debt. One would think that would be raising interest rates. Remember, there's also some talk among some economists, and even I saw in a CEO survey, of a much slower economy and possibility of having to cut not for good reasons but for bad reasons. So I think there are some who have seen that as a possibility. So there are many cross currents here, but I do not think that a Fed that is perceived to be beholden to the administration, any administration, or a Fed that's perceived to be ready to cut rates at a moment's notice is necessarily going to be a good thing. And I don't understand why that analysis is even in the marketplace.
Are you surprised the bond market is not speaking? Are you surprised the bond market is not speaking more vocally, though, when you hear the President go to take to Truth Social and say that Jay Powell should resign, as he did overnight?
Yes, to be fair, I am. I hear among individuals, obviously, a concern about that. But as I said, there are lots of cross currents that drive this. And some of it may well be a fear that the economy, as some of your panelists are talking about, is actually a little weaker than people perceive. And that may be also weighing a little bit on interest rates at the longer end. So I agree with you. It's a bit of a mystery. Right. I would have expected more of a bond market revolt.